If you're in crypto, this video will literally save you thousands of dollars. Today, we're going to talk about one specific loophole in crypto that may change in the coming months, and that is the wash sale. You can still use this today. To start, I want you to think of this video as a companion to my guide on crypto taxes. In that video, I talked about making sure to account for your losses as well as your gains, because you can actually save money. This is because when selling any investment for a loss, you can claim that loss as a tax deduction. Let's say you profited $5,000 this year from buying Bitcoin, but you also sold some Ethereum at a $300 loss. You can legally deduct the $300 loss from the taxes you owe from your $5,000 gain. In most situations, there's always caveats. Now, because you can write off losses, many investors do something that's called tax loss harvesting. Here, you're basically selling your assets at a loss so you can then claim those losses against other gains. This can cover some of the taxes you have to pay on ordinary income or capital gains for the year. It's really exciting. And this is where the trick comes in. After selling at a loss, you might get a brilliant idea. You might think, what if I sell at a loss but buy right back in? This way I can use the loss to my advantage on my taxes and still get the exposure to that asset in case the price shoots up in the future. And to this, I would say, slow your roll just a little bit. You're in the right headspace, but it isn't quite that simple. The first big roadblock here is the IRS has rules in place to prevent you from creating artificial losses in financial securities. And that's where the wash sale rule comes in. But luckily for us, for every rule, there's an exception. For financial securities like stocks or bonds, there's a time window within which you can't buy back the assets that you've sold. So put simply, the IRS saw people pulling this trick in the past, and they put a rule in place saying if you sell a security like a stock, you can't buy the same security or a quote substantially identical security 30 days before or after the sale and then use that sale as a tax deductible loss. So no artificial losses in financial securities. And I want you to note how I said before or after. There's a full 61-day window where you can't buy the same stock to effectively rig the tax system to your advantage, unfortunately.
Disappointed!
And you're probably, turning white right now, looking at your crypto rap sheet, thinking, well, this is no benefit to me. But I have wonderful news. For at least the rest of this year, this rule doesn't apply to crypto holdings. Seriously. And why is that, you ask? Because the SEC doesn't see crypto as a financial security. Not yet, anyways. That means you can buy and sell as much crypto as you want, allowing you to report your crypto losses as tax deductions. You can even deduct this against your regular income up to $3,000 per year. And I know this seems too good to be true. And before I show you exactly how this is done, I need to remind you that this is for entertainment purposes only. Always check your situation with an accountant because I am not your financial advisor. Now let's do an example. Let's say an investor bought the Squid Game token that ran to $0, where he then sold. We'll call him Jimothy. He lost $20,000 and never bought crypto again. You should have used my crypto scam checklist, Jimothy. This would have been avoided. Now here's where it gets fun. He can actually claim that $20,000 loss against ordinary income like wages, salaries, tips, bonuses, and interest income. Claim it against that. However, there's a limit. He can only claim $3,000 per year against ordinary income until all the losses are covered. So Jimothy will have a $3,000 deduction for the next 6 years, and the 7th year he'll have a partial $2,000 deduction, and at this point, his entire $20,000 will be accounted for. Now this is great and all, and can save you a ton of money, but let's go further and do an example using the lack of wash sale rules in crypto to our advantage. And this is where you can literally save thousands more. Okay. Jimothy. He buys $40,000 of Jimcoin, a crypto built specifically for people named Jim. No one saw it coming, but Jimcoin tanked, and Jimothy's stack is now worth $20,000. He wants to use this loss to his advantage, but he still wants to be in Jimcoin because there's some rumors that Jim Cramer is going to talk about it, and he wants exposure to Jimcoin. So Jimothy sells his position at $20,000 and buys right back in. His position is still worth $20,000, and he now has a capital loss of $20,000 as well that he can use on his taxes. But Jimothy also has some capital gains. He's been buying and selling other projects and is sitting on $10,000 in realized profits. So he has $20,000 in short-term losses and $10,000 in short-term gains at the end of the year. First, Jimothy can write off the $10,000 in gains with the $20,000 in losses, and he'll pay $0 in capital gains on that $10,000 in gains. Now he has a remaining $10,000 that he can use to write off either against future capital gains or $3,000 per year against ordinary income. And here's where it gets
bonkers.
For the sake of simplicity, let's say Jimothy's short-term capital gains and ordinary income tax rate is 22%. Because he sold and rebought Gymcoin instead of simply holding it, he saved $2,200 in tax in the first year by being able to write off that $10,000 gain, and he saves an additional $2,200 in tax over the next 4 years by writing off up to $3,000 per year in ordinary income. $4,400 in savings by doing nothing but clicking the sell and buy button. That's it. Now, if you're as hyped about this as I am, just make sure you click that subscribe button. And if you'd like to take this relationship one step further, check out my Patreon, linked in the description. There you'll find even more content, buy alerts, free coaching, daily signals, and a whole lot more. There's a reason why we have 10,000 satisfied members. Now, there are a few additional things you should consider. If you've been using tax loss harvesting as a strategy, you're likely familiar with everything I've discussed so far. And because crypto holdings aren't yet considered financial securities, they're actually a really easy way to stack up capital losses before the calendar year is out. And this applies in many countries besides just the United States, so double check if you don't live in the US. Crypto being the wild animal it is means it's easier to find opportunities here and there to sell at a loss and just reopen that position and save money on tax. Compare this to stocks or ETFs whose prices change in much smaller increments. But it's likely that the way the government sees crypto holdings is about to change. We're already seeing new regulations like the introduction of the $1.2 trillion infrastructure package. In case you didn't see my breakdown, it's estimated that the government will earn about $28 billion in tax revenue through crypto alone. And this is due to new reporting requirements placed on crypto brokerages, a term that needs some correction. Until we know more, don't bet on having the wash sale loophole stick around forever. And I want to point out that if crypto becomes a financial security in the eyes of the SEC, the added volatility in crypto could possibly do more damage to your wash sale strategy than benefit. For example, if you decide to close your position to harvest a tax loss while Bitcoin is at a lower price, having to wait 31 days before buying back in could leave you paying a higher price for those coins in return. However, an interesting workaround that I found is that ETFs aren't considered same or substantially similar to stocks. So what you could do if you wanted to lock in tax losses is close a stock position and reinvest that moolah into an ETF which contains the same stock. Now, of course, your exposure wouldn't be the exact same, but that's kind of the point. The ETF is different enough that the IRS wouldn't consider your losses artificial, and once your 31-day lockout period is over, you can choose to either keep the ETF or close it to open a position in the stock that you originally had. Now, this is relevant because of the recently approved futures ETFs for Bitcoin and other cryptocurrencies. This could become a popular strategy for crypto tax loss harvesting very soon if we see a change in the wash sale rules. If you haven't used a tax loss harvesting strategy before, bear in mind that the wash sale rule makes it so that your spouse or a corporation you control can't buy the asset for you. And you probably shouldn't even have your wife's boyfriend buy a stock for you to get past that wash sale rule either.
The other man, who's the guy? Who is it?
It's you. I'm married.
I'm the mistress?
Now, if you haven't already noticed, I've cited the IRS describing the wash sale rule as being applicable to the same or substantially similar assets. We don't know exactly how these rules will work for crypto yet because they haven't been officially recognized as financial securities, but let's take a look at some additional loopholes in financial securities to help better understand so we can plan ahead with crypto if this change does happen in the future. So we already know that a stock and an ETF containing a stock are not considered to be substantially identical investments. But what about stocks of similar companies? Well, good news is stocks from different companies in the same industry are not considered identical, even if they move in the same direction. So you can put down a capital loss on the sale of some stock in company A while reinvesting that money into company B without waiting for the wash sale lockout period to expire. Also, taking things one step further, if you sold the preferred stock of a company to buy common stock in that same company, many times that isn't even considered substantially similar, with some exceptions, of course. Some companies' preferred stock does get tagged as identical when you can trade between the two without restrictions. So it's always best to consult with a tax professional if this is part of your tax loss harvesting strategy, or really any of these situations. It's always best to have someone look over the numbers for you because no two situations are exactly alike. So if the wash sale rule does come for crypto, we can predict that selling one kind of coin or token to buy another will not be considered substantially identical to another. Either way, until we see a rule change here, we can use the loose regulations to our advantage by selling and rebuying any crypto when prices drop below our cost basis and using that to help our future selves save thousands of dollars. Now, there are other ways to save tax on crypto gains, like moving to Puerto Rico or taking loans out against your position, or you can utilize a service like my newest sponsor, Capital. With iTrust, you can actually place your crypto in a Roth retirement account, and this means you can buy, sell, and trade to your heart's content and pay no capital gains on your wins, all within this account because it's a retirement account. This is amazing for traders. With a Roth, you pay your tax upfront when putting the money in the account, and then at retirement, you pay no tax once you start pulling out at age 59 and a half years old. This is probably the most simple way to save on all capital gains tax in crypto. iTrust will be linked in the description, and if you use that link to open an account, you'll receive $100 in free Bitcoin just for joining. And that's going to do it for today. I would like to thank you so much for watching, and I hope you have a profitable day.